Welcome back to the channel. My name is Steven. I'm a pharmacist and I own 52 units of real estate. So I had a great question in the comments asking, it's a two-part question. So is a cash flow that I make $10,000 a month from real estate including the mortgage payments, i.e. they meet the 1% rule? Also, would you be open to doing a video on how you manage your taxes, i.e. do you do it yourself, hire a CPA, etc.? So to answer the first question, which is easy, it's in response to my video talking about my 7 streams of income as a pharmacist, where I make $23,000, $350 a month net, right? So this is factoring in taxes for my W-2 income. This is factoring in all my expenses from real estate. So this includes the property tax, the insurance, the mortgage, the expenses, property management, repairs, maintenance, everything, right? So I net take home in my pocket about $23,000 a month. So the cash flow from real estate, $10,000 a month, is after the mortgage payments. And most of my properties do meet the 1% rule. So my apartments in Oklahoma, I own a 26 unit apartment complex, which I bought for $500,000. And I put in additional $300,000 to renovate it. So I'm all in for $800,000. And this thing grosses about $16,000 a month. So I'm at the 2% rule on my 26 unit apartment complex, which is why this one cash flows, significantly, at least $6,000, $7,000 a month. My 20 unit, I bought for $350K, put in about $150K worth of renovation. So I'm all in for $500,000, and this thing grosses around $9,000 a month. So this one cash flows about $1,500 bucks a month as well, because my interest rate's a little high. So when I buy properties, multifamily in Oklahoma, they all meet the 1% rule. All my single family homes in California do not meet the 1% rule. They're cash flow negative. So my cash flow negative California single family homes is carried by my 2% rule Oklahoma multifamily apartment complexes. Right? So that's how my portfolio is balanced. So that's how I have that cash flow. So my California real estate portfolio is probably negative $3,000 collectively, but my Oklahoma portfolio probably, plus my mobile home park note, probably does cash flow, about $12,000, $13,000, right? So it kind of comes out to $10,000. So that answers part one of the question. So part two of the question is, how do I manage my taxes? So I actually mentioned this in a few videos, but actually, believe it or not, I owned 90 units at one point, 52 units currently, and I started doing my own taxes in 2017 till present day. So for the past 7 years, I've been doing my own taxes on Turbotax, or Intuit, I believe. Intuit, Turbotax. And in the beginning, I just started off, like in 2017, I did my own taxes, and I just had a W-2 income, and I owned my primary residence, which I house hacked, right? So I eased my way into it. So in 2017, I just did my taxes plus my primary residence, which I did rent out 3 rooms. So 25% of the house was Schedule A, which is my primary residence, and then 75% of the house is Schedule E. So 75% of the house was a tax write-off, right? I could write off 75% of the HOA, 75% of the utilities, 75% of the property tax, 75% of the insurance, right? So because 75% was Schedule E, and then 25% was my primary residence, Schedule A, right? So in 2019, I bought another primary residence and rented out the prior house, my first house. So that house now became all Schedule E, and now my next house that I lived in San Francisco, once again, I rented out part of the house. So, 25% was Schedule A, 75% was Schedule E. And this just continued, right? So I did all this on TurboTax. And people think it's really complicated, but TurboTax actually really dumbs it down. Like, I'm not sponsored by TurboTax yet. Maybe one day, right? Not yet, but maybe one day. If I keep on doing my taxes on TurboTax, which I will. But it's pretty intuitive. You just go through it, and it gets easier and easier every year because it takes your information from the prior year and you just add on to it. So, like, for example, my W-2 income is easy, right? Like, if you worked at the same job, you just import your next W-2. Sometimes you can do it electronically, import your W-2 in, and you just update my brokerage account. So, I got my Vanguard index funds, I got my Charles Schwab index fund. So whatever dividends or interest comes in from that gets pulled as well electronically. I get my high yield savings account, that's pulled in electronically. So it's pretty easy, right? And then my real estate, which is probably a little bit more complicated, but all my real estate's owned in LLCs because I own a lot of properties, right? I have a holding company, which owns which is an LLC, which then owns my single member LLCs, which then own my real estate. So I have no partners, right? So I own all my LLCs 100%, which is owned 100% by my holding company, which my trust owns 100%. So realistically, all the taxes just funnel down to me because all my LLCs are disregarded for tax purposes, right? So what happens is if I have a property, what you do is under, I think, your real estate, you just add, okay, do you own real estate? And then like, I think it's like yes or no. Like, so I just click yes, right? And at that point, it's like, okay, like what's the address? And then you'll punch in the address and it's gonna ask, okay, what's the land value? And then what's the structure value? And why they're asking that is because the land value does not get depreciated. The structure value of the building is what gets depreciated. So for example, if I have $1 million house, and let's just say the land's worth $500,000, and then that means that the building is worth $500,000. So that $500,000 building is what's depreciated over 27 and a half years for residential real estate, or if it's commercial real estate, it's I think 39 years or 39 years or 29 years, like one of those two. But anyways, it does it for you. So you just got to categorize it. So if you own like a single family home that's a rental, you just click it's a single family home rental and it'll automatically calculate the depreciation of $500,000 divided by 27.5. And you can read the comments, like there's bubbles that you hover over and it'll just explain to you, right? And if you select commercial real estate, it'll actually calculate for you that it's like divided by, I think 39 years or 29 years or whatever that is. So you have to do that for each property. So I have a line item for my, my first single family home. So it's pretty easy. I said, okay, how much rent do you get? So it's easy. You get $1,000 a month in rent times 12 months. You make $12,000 gross. What's your expense for the year? So your expense is your property tax. There's categories for property tax, insurance, HOA, utilities, repairs, any travel costs, right? So it's just these categories that you just go through one by one. And because I have a business account and a business credit card, it all funnels in that account. So it's easy for me to track, right? So I just input all that information. And then it's going to ask, okay, well, any mortgage interest that you pay, because the mortgage interest is tax deductible. So I could look at my mortgage statement and see how much I pay for the whole year, right? That whatever it goes to your principal, you can't write off, just the interest payment only. So you write that down, and next you're going to depreciate, right? So you're going to depreciate the structure value over 27 and a half years or 39 years, depending if it's residential or commercial. And it'll calculate that for you automatically. But let's say you did a repair. Let's say I renovated my single family home and I spent $20,000 to do that repair. That will typically, you can put that in as a renovation, and it's going to say, oh, do you want to depreciate that over 5 years? Typically is standard, or you can bonus depreciate all of that year one. But it breaks it down for you. So it sounds complicated, but it literally gives you options. You want to do it over 5 years, which is standard, or you can bonus depreciate up to, I don't know what it is, but at one point you can do 100%, maybe it's 80% now, maybe it's 60% now. But whatever that is, you can accelerate, bonus depreciate some of that if you want to, right? And a lot of times on the property, they're going to ask you, are you actively managing it? Are you passively managing it? And are you a real estate professional? At minimum, you're actively managing it, but because if you put passive, you don't get any write-offs. But if you put active management, if you make over, I think $150,000, which I do, whatever passive losses just carry forward, right? And the last category is real estate professional status, which basically means that if you don't have a full-time job and you put in more hours into real estate than you do another job, then you qualify at least 50% as a real estate professional status. So let's just say I worked as a pharmacist for only 20 hours a week, but I was a real estate professional for 21 hours a week. Technically, I qualify as a real estate professional status, which means that the passive losses from real estate can then be utilized to offset my active income, right? And once again, this will ask you the question, but if you work full-time W-2, even though you work 40 hours a week and you do 41 hours of real estate, they don't care. You work full-time W-2, you will not become a real estate professional, right? So, that's what I learned over time. So, you go through all that, and then, so for me, I don't qualify as a real estate professional. I'm an active investor, but I don't get right off the passive losses because my active income is too high, right? So it just carries forward to another day until I become a real estate professional. If I get married and my wife is a real estate professional, I will qualify collectively together when we file our taxes joint, right? So that might went above everyone's head, but just stick with me here, right? So I did property number 1, and then I do the same thing for property number 2. Income, expenses, depreciation. Then I'm gonna do my apartment complex, right? Income, it's easier in my apartments because, so I have property, single family home number 1, single family home number 2, single family home number 3, single family number 4. My apartments are easy because I have monthly P&L statements, so it's easy, right? Like I can literally just input like my income, they're all my expenses, and these are my interest rate that I write off, so it's easy, right? Like, and if you did repairs, you depreciate that over 5 years, or you can bonus accelerate depreciate it. And the part that I'd say gets kind of tricky is, even though it's an LLC, like it's disregarded, so it just funnels into me, so I just have to sign it to an LLC, right? And then you just basically go through all that, and that's how I do all my real estate. So like when I file my taxes for the next year, it just pre-populates all the real estate I had from the year prior into my next document. If I bought more real estate, I just add that real estate onto my tax. So it carries forward every year, and they see your numbers from last year. So, for the most part, it shouldn't really vary if assuming it's stable. So that's how I kind of do it with LLCs, right, that are disregarded. The next part that gets more interesting is I have a coaching business, right? Like I have a mentorship, and like for that, I don't have, I'm just a sole proprietor. I don't have an S corp yet, but even if I did have an S corp, it's not difficult. Like I have to file the own taxes for the S corp, but how that affects me is that, let's say the S corp, it's going to issue two things. It's going to issue me a W-2 income as well as a K-1, which you can basically, basically defer paying taxes on that or avoid paying taxes on that, right? So let's just say in my coaching business, I made $100,000, right? And let's say after my expenses of $40,000, I have $60,000 net. From that $60,000, I need to pay me a salary, right? So I'm going to issue myself a W-2, and let's just say I issue myself a W-2 of let's say $30,000 for simplicity as a W-2, and then $30,000 as a K-1, which stays in the LLC that I avoid paying tax on. Whatever gets issued to me, to my income now, gets added to my income tax, right? So it gets added to my pharmacist salary, my index fund dividends, right? So it gets added onto me. So the goal is you want that W-2 to be as minimal as possible, but not milking it where I'm just paying myself $1 that I'm gonna get audited, right? I have to pay myself a reasonable salary that's not too low, but the rest you pass through as your K1, or you can have the S corp invest in like a 401k. So that's how it all funnels, right? Like I just take the K1 and the W-2 income and add that to my personal tax return. So that's how I do it. And it's hard doing the first property you do. It's hard. The first time you depreciate a property, it's hard. Like I saw my mobile home park, and I was trying to do that into TurboTax, and that was a little bit hard. But there's forums on TurboTax which you can go through as guidance, so it's not as bad as you think, right? Like you just can go through TurboTax, look it up. And I remember when I sold my property, what confused me was that I had to break up I forgot I had depreciating as 3 or 4 depreciations on my tax return, and I had to divvy up the sales price based on the depreciation, right? And then that's how it was divvied up. It was weird. And then when you sell a property, you get depreciation recapture, so you have to pay back. You pay the piper, you get the depreciation recapture, so it counts against you, right? When you sell a property, and then when you sell a property, I sold mine for a loss of $100,000. That actually offset my active income by $100,000 because I have active losses, which offsets my active income. So if you stay this long, thank you. But pretty much it's pretty user friendly, and over time it gets easier and easier. Like when I do my tax returns for this year, I didn't really, I sold my property last year, so it's pretty easy. Like it just carries forward every year. So this one I expect it to be pretty easy. But like you said, for me, I don't like hiring a CPA. I actually self-educate myself a lot about taxes and accounting, and a lot of podcasts out there, and a lot of stuff you can kind of Google on the forums. So really that's how I do my taxes, right? But I might get to the point where maybe I will hire a CPA, but at least I know enough that I can trust but verify my CPA, right? Because most CPAs are not that good, right? Most CPAs do not own real estate, so they don't know how to manage it. So anyways, if you want to join the Making Multifamily Money mentorship program, you want to buy multifamily real estate with some guidance, check out my mentorship program. If you want to join my school community and surround yourself with multifamily investors, check out my school program as well. Links down below. Please let me know what questions you have. Please like, comment, subscribe. I hope to see you next one. Thank you so much.